great to see all of you. Real quick, as a quick introduction, I want to talk about while we're here and all that kind of stuff, and why we're doing this. Welcome to another Bourbon and Blockchain series. This is going to be a tax talk series where we're going to talk about tax-related information. This was brought up by the community. This is something that they wanted, and I'm glad they did because this type of information helps create well-rounded investors, right? So I think everybody has the same goal here that they all want to be good investors and they want to be well educated in the topic. So this is one of the things that everybody should try to get knowledge on. They should all try to know the different aspects of investing with crypto, and this is one of those subjects. So that's why we started this. Um, Quick disclaimer before we get started: nothing here is going to be taken out of context. This is not financial advice. Everything in this that we're going to be talking about is going to be examples of taxation issues and examples of tax problems and whatnot. They're just examples, so they cannot be applied to every single situation. All tax examples and all tax situations are unique in themselves, so more information could be required to give you a more educated answer. So don't just go based off of what you hear. Make sure that you seek out more information if you need additional advice. This is just an overview. So with that being said, today I have with me a CPA, certified public accountant, that specializes in crypto taxation, and I will let him continue forward and introduce himself. So, sir, thank you for being here.
Thank you, Dreko, again for having me on. My name is Sean Mulrow. I'm with a CPA firm out in the suburbs of Chicago, and we are kind of priding ourselves in becoming somewhat experts in the crypto uh, taxation field. There's not a lot of folks in our industry that are trying to tackle this, so we're trying to be out in front of the ball on this and do what we can to help our clients out. And quite frankly, it's a very fascinating industry. So it's crazy times. Crypto's ever evolving. The laws in flux, and crypto's becoming more established in our society. So there's nothing better than at this point in time, especially with tax season right around the corner, to start thinking about this. So I know tax isn't the most exciting topic, so we'll try to keep it light. Try not to dive too far into the details on it and bog anyone down. But it's a very good time to be thinking about this. I'm excited that you guys are all here. So thank you for taking some time out of your night to listen in.
Well, if it
Um,
helps any, I'm also sipping on bourbon, so I think that kind of lessens the blow a little bit too.
yeah,
So,
eh,
coming with the theme, right? Bourbon and taxation. Go ahead and get that going.
exactly. So everyone pour a drink, get comfortable. We'll plan to do talk for about 20 or 30 minutes or so. Give you guys a high level about the firm. I know you guys want to know more about the taxation of the cryptocurrencies and the different transactions as they stand. So we'll get into that as well, and then also get into why it's important and what we see as one of the biggest issues in that with the tax reporting as it stands right now. So a little background on us. As I mentioned, we're a firm out in the suburbs of Chicago. We're out in Schaumburg. If anyone's familiar with the area, we are a part law firm and part accounting and tax. So we've got three folks on our law practice. We specialize in working with closely held businesses, estate planning, and then real estate transactions. And we do some corporate work as well. So that part of the business complements what we do on the accounting and tax side of things, where primarily we're working once again with closely held businesses, their owners doing their tax returns and tax planning. And the good thing is, I mean, although we are small, we have backgrounds from larger firms. So we're small, but we're nimble, responsive, and we have resources that we can provide and bring to the table. So it's a great partnership potentially that we could have together for our clients. So what we do is we are able to utilize those resources and be responsive and provide great work for our clients. So what I wanted to get into, hey, why are we talking today? What CPA know? What do they know about crypto that I don't? And quite frankly, probably not a ton outside of the crypto side of things, but we're learning a ton on the taxation part of it. So why us? So we got into crypto about 2 years ago. We had clients coming to our door saying, "Hey, I've got miners, I've got Ethereum, Bitcoin. I need to know how to report this." And at that point, our firm, it was relatively new to us. We've heard about it in the news, so we started working on crypto taxation since then. It's picked up a lot in the last 6 months or so. But in order to get ourselves aligned with the crypto community, one of the best ways that myself and my partner Chris decided that, hey, how are we going to learn about this stuff? We're going to just dive into it ourselves. So we've got an Ethereum miner. It's over 2 years old now. It, quite frankly, doesn't do as well as it used to, but that's how we got our initial step into the door. And then in the same note, we started working with folks like Dreko on this thing, and they brought strong nodes and things like that to our attention. So our best way of learning about it is we bought a couple nodes ourselves. We just recently invested in certain DAO projects. So I can assure you that we're doing everything in our power to get as involved and learn about crypto as much as possible. And then, of course, the tax ramifications, and that's why we're here tonight.
Yeah, and
So
I want to highlight that because I want everybody to understand that this firm and specifically Sean, they're very in tune with what's going on in the crypto world because they're doing it as well. So they're doing their best to become subject matter experts on crypto by doing it themselves, and I think that's important because not a lot of people are doing that. So when you say, "Hey, I have all these fees and I know it's hard to explain," you don't have to explain that because they know, for example, strong fees because they pay them as well. So I think that's very important when you're looking for somebody that you want to work with, no matter what CPA or what law firm you go with, ask them what they know about crypto and maybe ask them some specific questions. And if they can't answer them, maybe you need to continue to look for somebody that it has more knowledge in the field.
yeah, no, that's a great point, and part of it too is, you guys are gonna educate any kind of professional that you find. So you guys are the building blocks on in the crypto world. I mean, this thing is still new, it's in flux, and you guys know a lot, and you'll bring a lot to the table. But then also your CPA, your attorneys, they should be trying to educate themselves as well. There are a lot of attorneys and CPAs in this world that won't touch them. As I mentioned, Chris and I came from larger firm backgrounds, and we've reached out to those folks to see what their thoughts are on crypto, how they're handling it, and quite frankly, they're just ignoring it. They don't want to touch it. We don't agree with that stance. We think this thing's going to take over, and it's not going away anytime soon. So it's we're happy to be part of the community as it grows, and be part of the innovators on the tax side of things as we get um, into it becoming more established. The IRS starting to come up with more concrete guidance on what we're supposed to do, and hopefully we can all help mold that as this thing starts to roll on. So what I want to get into, so why did crypto start to um, fancy our interest here? And really, what it is the blockchain. So all you guys know is, crypto is all built on the blockchain, and really everything ties back to the blockchain. And what's really interesting to us as accountants is the blockchain in itself is somewhat of an accounting system, and the fact that you don't need outside audits of the blockchain because everything is um, there's no double entries, there's no everything's public, so you can see everything there. So from our perspective, when a Fortune 500 company does their books, a outside accounting firm has to come in and audit it, make sure everything was done correctly and whatnot. But on the blockchain, everything's automatic. There's validation. There's so many um, things, I guess. So validations and excuse me, wow, my computer's excuse me, sorry about that. So there's so many double fact checks there where everyone knows that everything coming out of the blockchain is well done and legit. So granted, there's scammers and things like out there, but the information processed on the blockchain itself is all current, correct, and whatnot. So it's a very interesting topic. It's very different than anything we've ever seen in the accounting world. So it brought a lot of attention of ours, and we that's part of the reason why we wanted to get into it. And then also our clients are bringing to the table, and one of the biggest reasons too is that the IRS is starting to crack down on this stuff. So you probably noticed on your last year's tax return that the IRS was actually asking, "Hey, at any time during the year, did you receive, sell, send, exchange, and whatnot any virtual currency?" And that question is starting to evolve with the IRS as they know, hey, this thing doesn't necessarily work the way we thought it was. Maybe you're not selling it, maybe you're just exchanging and whatnot. So these questions on the tax return are starting to become more involved, where they're replacing words like acquire with disposed of and things like that to try to make sure, hey, that question you can't be kind of vague on it from the IRS standpoint because you could kind of skirt your way around it. So they're starting to hammer down on who they want to report the cryptocurrencies. And what they know is that when COVID hit, everyone was stuck at home, and COVID actually, well, just like the market, cryptos took a dump early in March of 2020, but it rebounded and it's been all-time high. So a bunch of people got in. So there's retail investors in here that were never involved. So the IRS knows it caught everyone else's eye as well. So they want to be on the forefront. So what they're doing is part of President Biden's plan to kind of tackle crypto and pay for some of the stimulus money. They are cracking down on cryptocurrencies with somewhat of a hammer. It's called what they've got going on behind the scenes. You may or may not have heard of it. It's Operation Hidden Treasure, where they're actually putting a ton of money into new agents who are learning about cryptocurrencies, and then they're going to audit tax returns and whatnot. So you want to be legit. You want to report your tax. You want to report your transactions because you're only going to get away with it for so long, and you don't want to be on the back end paying a bunch of penalties and fines for not reporting. With that said, we're talking a lot about tax, and you would think, hey, that's going to be a huge issue. That's got to be the biggest issue at this point. And unfortunately, even with the law being in flux, everyone got to get different opinion on what cryptocurrency really is and how it should be taxed. That's not even the biggest problem we've seen to date. So as we've picked up more and more clients that are in situations like yourselves, where they've bought nodes and they've done well with them, they've got into separate DAO projects and whatnot. The biggest problem that we're encountering is the bookkeeping itself. It's actually quite the nightmare. And anyone in your guys' position can probably attest to the fact that, hey, I don't really even know what I've made. It's you can see your account growing, but as far as what's taxable and what not, actually starts with the fundamental blocks of bookkeeping. And so the blockchain in itself does a great job in recording all that, but how do I get that into a report that I can give to my accountant or prepare myself, however you want to do it, to prepare your tax return? And quite frankly, the answer is still in flux itself. There are softwares out there, such as CoinTracker, Coinly, ZenLedger, that do a pretty good job for if you're just trading cryptos, maybe doing a little staking, earning rewards that way. But they seem to be a little bit incomplete when you start talking about nodes and mining and whatnot, because there's a lot of manual entries that still have to go into it. And it just seems that the softwares in themselves aren't doing a great job. And so there's going to be a lot of talk about that. I'm sure I saw a bunch of questions as well in the Discord channel about, hey, how do I even report this? What softwares? And we could talk about that later as well. But that is our biggest concern, because really, we're already at January 13th today. Tax season ends in 3 months, and it could take you a month or a few weeks to even try to do this by hand. If you try to do everything by hand, you're never going to get it done. We have to use automation where we can, even if it's incomplete, to at least get us a starting point to start talking about, hey, is this reasonable? Does this seem like I made this much money? It's telling me I lost money, but I was able to pull money out to go do certain things or invest in other projects. Then it's probably not a good report, and we probably got to find the next one. So right now it's a work in progress, and what we're doing for our clients is we're trying to help guide them. Granted, our firm can't do the bookkeeping either, just like you couldn't. It'd be impossible to go through 8,000 transactions through a CSV file and account for all of that. So utilizing automation and whatnot, we're trying to help our clients by guiding them in the direction of, hey, here's what we're going to need for the tax return. At a high level, if you're in this type of project, here's what we're going to need. And we've got more information coming out to people who have signed up with us on that, and we're going to provide some guidance and hopefully try to ease the pain of our clients on that. And I'm happy to share a little bit of that today as well. A lot of it's still in the works and at a high level, but it's going to be interesting as we come in this next couple of weeks. What really comes out of the tax reporting, because we expect the next 2 to 5 years, there's going to be software that becomes complete as more companies are willing to invest in the cryptocurrency world, as they know it's not going away, and there's a need out there, quite frankly, for that reporting software. So it's really going to be a 2 to 3 year battle, is what we're expecting on the bookkeeping side of things. So you guys are really going to have to hang in there, and a lot of it is going to fall back on you guys. Whether or not you work with us or any other CPA, they're not going to be able to do all the bookkeeping for you. But really, you should rely on your CPAs to provide guidance and whatnot. whether it's us or another CPA from that standpoint. Um, so we've talked, hey, IRS is starting to crack down. My bookkeeping is tough to do. What's some of the risk of inaccurate reporting? So what we'd like to do, ideally, what's the easiest path to get to a tax return? Now, a lot of people, hey, ideally we pay less tax. Not paying tax isn't a fun topic, but when you're making money, you got to pay the IRS their fair share. Otherwise, they're going to come after you. And here's kind of an interesting thing. So, from a legal side of things, in this country, when this country, I mean the US, I know we may have viewers or listeners from all over the country or all over the world, but in the US at least, if you kill somebody, you're actually innocent until you're proven guilty. The burden of proof is on the government to prove that you're guilty. And the only exception to that, or one of the exceptions of that, is tax law here in the US. You're actually guilty until you can prove you're not. So the IRS actually will come in with a determination saying, all right, here's what I see from your records, or they may make something up. They want you to provide your records. Show me why this expense is deductible, or how you paid for this, and what happened with this money that you earned from this project. Why didn't you report this? So what's got to happen is we got to have some sort of reasonable, substantiated records in order to um, defend ourselves. And at this point, everything's unsettled, tax law, the bookkeeping and whatnot. And the IRS is going to understand that, or we're going to try to make sure that they do. So everything that we do has to be with our best effort, best foot forward. Determining reasonable requests of you guys, or of how we're going to report things, because there are projects that are not actually being able to be reported in some of these automated systems. I know they're on different blockchains and whatnot, so it makes it impossible. So you got to come up with a reasonable method on your own, and that's part of what we aim to build for our clients, is to help them guide through that. So there are calculators out there for certain projects. I know I believe you guys had talked with the calculator guy, Steven, on strong nodes. And I believe a lot of folks in this community as that's where you guys started. So it's good to utilize whatever we can. So things like that are helpful, at the very least, getting us started to make sure we're in the right spot. And a lot of that also has to do with your input as well. So a lot of that is you funnel the information into the calculator. So what's going to happen too, as you deal with your CPA and whatnot, there's a saying in the accounting world, is garbage in is garbage out. So if you don't provide good information to your accountant or your CPA, you're not going to get a good tax return, and then you could be in trouble if the IRS were ever to audit you. So unfortunately, there's going to be a lot of work to be done on your individual side, but you should expect some help either from automated systems or some guidance from your CPA. And if you're not getting that, I would encourage you to reach out. We're happy to help, but then also just making sure that you have that guidance on your end. So when we talk about that, we've hit the need for bookkeeping, but at the end of the day, what's even taxable? So when you start talking about, hey, when is staking taxable to me? When are my rewards taxable to me? And actually, there's a lot of misconceptions out where, hey, if I never take any money out and I don't put it into US dollars, I don't have any issues. I've never actually recognized any income, and that's actually a misconception. The second any of this hits your wallet and you're able to claim it, or even before it hits your wallet, there's arguments out there that even if you're just staking, like Hector DAO is one that I know I've put some money into. So I know the rewards are, I'm getting rebases 8 hour or every 8 hours, and technically there can be an argument from the IRS that every 8 hours you have ordinary income that you need to recognize and report in your tax return. And the reason being is they go back to these constructive receipt rules. And if you're not familiar with that is, a lot of what small business owners have tried to do, and the IRS has tried to stop them with rules like constructive receipt, is back in the day, you'd receive a check, say for $20,000 on December 31st. And a savvy business owner saying, all right, I'm just not going to cash this until tomorrow. So I push this $20,000 into next year's tax return. So it defers my tax payment for a whole year, which is great because now you're able to put it back in your company, invest it and whatnot. So the IRS became aware of this, and they put in the constructive receipt rules where they said, all right, let me see that check. When did it get here? Okay, you had it sitting here on the 31st. You didn't cash it until the first. Technically, you had to you should be reporting that as income in the prior tax year when you received it. So there's arguments being floated around from the few professionals that are trying to tackle cryptocurrency taxation that the IRS may take that position. And I think it would be an easy position for them to take where, hey, this particular reward was in your wallet, and all that stopped you from taking it back was hitting a button that says claim, which is very similar to just cashing your check. Of course, there's fees associated with that, but I want everyone aware of that. So when these rewards are hitting your accounts, it's quite frankly, it's going to be income to you guys, and we got to utilize different strategies, whether it be retirement planning, um, self-directed Roth IRAs, other deductible expenses to try to reduce that, or we just have to cash flow plan and be ready. We can get into that in a little bit. But from a high level, a lot of what you guys are doing is going to be ordinary income. So staking, earning these rebase rewards from DAOs, node projects, mining. Anytime that hits your wallet, it's going to be a taxable transaction, ordinary income to you. Another misconception, or maybe not even a misconception, something that you may not even be aware of, is that quite frankly, when you might have created taxable transactions even before you got into these types of projects, where if you were just holding Ethereum, say you bought $1,000 of it, and the price doubles and goes up to $2,000, you have unrealized gains, no taxable event there. But say, hey, I've lost my interest in Ethereum, and I now want to buy Bitcoin. So I exchanged my Ethereum for Bitcoin. The IRS says that that is a taxable transaction to you. It's actually capital gain, whether or not it's long term or short term, depends on how long you held that Ethereum. But now you've exchanged your coin. You haven't actually you actually don't have any US dollars out of it that you've realized, but you have an attrition or a cession to wealth in the fact that your Ethereum that you bought for 1,000 got you $2,000 of Bitcoin. So that's how the IRS is viewing that. So without taking out any money, I saw some questions on that in the Discord saying, "Hey, I've never taken out any money. I haven't realized anything in US dollars. I should be good, right?" And the answer is no. The IRS is still going to expect you to report income based on what you've earned. They're going to treat your crypto wallets as effectively the same as a regular wallet, and the fact that now you have more money in it now because of certain projects. Although the problem becomes the wherewithal to pay, and the fact that you can't really pay with your cryptos. You're going to have to liquidate and continue to trigger taxable events, and the fact that you got to sell some of your cryptos to pay your tax, and then that's going to create additional taxable events. So there are options out there to take a loan based on the crypto that you have, collateralize your cryptos in order to not have to liquidate and pay your tax and then pay back the loan with some of your crypto earnings. And some of that I'm not going to get into a lot today. Quite frankly, it's something I'm still looking into as recommendations for our clients, but it's something that is very interesting. You won't have to liquidate your interest in the fact that, and they continue to earn for you. And then as long as your passive investments are earning money for you, it'll actually pay back your loan. So with that said, I want to talk about what our recommendations are. So depending on your situation, so a lot of the folks that we're working with are either individuals or they're getting into this with their spouse, or even with friends or family, and everyone's got different situations. But from our perspective, the route to go here is to set up an LLC and make an S corp election. So let's talk about that for a minute. Why would I want to do that? In order to do that, I'm going to create an additional tax return that I need to file, and there are accounting and tax fees for that. I'm going to have to take a reasonable salary, and we'll get into why in a minute. So that's going to create payroll tax returns, and you're going to create additional costs. So from your perspective, you're probably thinking, no, I don't want to do that. That's additional cost. I'll just report my personal return. There's a couple bad things about that. In our perspective, the IRS could make a pretty decent argument that this is a hobby and not a trader business if we don't take the necessary steps to show that it is. And the bad part about a hobby is the IRS says, okay, any revenues from this project, you're going to pick up, you're going to recognize on your tax return, but any expenses related to it, you don't get to deduct anything. So that would be a terrible situation. You're putting money into nodes, you're receiving rewards, and you're putting that money back into nodes, and you have no cash left over, but the IRS is not allowing any expenses, but they are providing or making you pick up the revenue as taxable income on your tax return. So now you're upside down with taxes and it becomes a huge nightmare. So that's the big first reason why we think that an LLC set up as an S corporation creates a little bit of separation from you and your cryptocurrencies, and then also legitimizes the fact that hey, this is a trader business that's being operated for profit motive. I've set up a separate business. I have a separate bank account. I'm following all these corporate formalities. This is not a hobby for me. It may be for some folks, but not for me. And this will help make that argument should the IRS ever to come out and try to challenge that. The other side that is key is self-employment taxes. So I'm not sure how familiar everyone is with taxation, but if you're self-employed, so you're earning income from a trader business and you operate as a sole proprietor, all this income is going to be reported on your personal return on a Schedule C. You're going to get the regular same income tax rates that you would if income was reported to you through your W 2 or passes through to you through this S corporation. I'll touch on that in a minute. But what's going to happen is the IRS is going to hit you with an additional 15.3% tax for self employment taxes. You might ask yourself, why would they do that? Effectively, what the self employment tax is they are trying to have self employed individuals contribute to Social Security and Medicare. So, as a W 2 employee, as I'm sure a number of you guys are, your employer will withhold Social Security and Medicare taxes from your paycheck. So you'd see 6.2% for Social Security, 1.45% for Medicare. So that totals up to 7.65%. And the good news as the employee, your employer has to match that for you. So 7.65 times 2 is 15.3%. But as a self-employed individual now, there's no employer to match. So don't even worry about breaking out. Here's what the Social Security and the Medicare portion is on what's being withheld. We're just going to charge you 15.3%, all its self-employment tax, and have you contribute that way. What's nice about an S corporation is that it shields you, partially at least, from that tax. So let's just say you make $100,000 in cryptocurrencies, you're going to pay $15,300 in self-employment taxes. An S corporation acts as a pass-through entity, and the fact that it actually doesn't pay any federal income tax on its own. What it'll do is it'll calculate what your guys' taxable income would be at the end of the year and determine, all right, here's what the profit was. It was $100,000. S corporations don't pay federal income tax. They actually pass through that income to you on your personal return through a Schedule K1 that you would receive. So it actually, instead of listing out, here's my revenues are and here's a breakout of all my expenses, this K1 will actually have on line one, ordinary income. Pass through to my shareholder is $100,000. So now you've got $100,000 on your personal return that you got to pick up regular income tax on either way. But the S corp earnings are actually not subject to self-employment tax. So you save $15,000 and change on that. So that sounds great. And the IRS is aware of that. So what they make you do is they make you take a reasonable wage out of your S corporation. And whatever you determine that to be, you have to make a reasonable argument for why you're paying yourself. It technically is supposed to be, hey, what would you pay someone to do the work that you're doing for your business? And everyone's got their own arguments. A lot of people try to play around with the tax game. Here's what would benefit me the most, and sometimes it comes out close to that number, and you just got to come up with a reasonable determination for the IRS as to why that wage is what it is. So, say it was $50,000 that you ended up paying yourself. With that said, you're still going to pay payroll taxes. So as we talked about with the W-2, you're still going to, as an employee, have to contribute to Social Security and Medicare, and now you're the employer, so you have to match. But when you think about it, you've actually saved $7,650 on your taxes through self-employment tax. So it's actually a huge, huge benefit. So the S corporation saves you money there. So you got two reasons there: avoid the hobby issues, and then also self-employment tax savings. And that way, any of your necessary trade or business expenses and that are ordinary and necessary to the business that you be able to deduct aren't in jeopardy of being denied from the hobby loss rules from the IRS. So I know I've talked about a lot. We've kind of hit 30 minutes there, so I don't want to go too much longer without trying to give you guys time to have some questions here. Dreko, you want to run through some of the questions that were provided in the Discord before, and then we could kind of start taking questions from anything I might have talked about, anyone may still have after we run through those?
Yeah, we got a couple more questions on the side while you were talking as well, but I want to
Perfect.
hit on something really fast. Um, if you guys are interested in opening up an LLC S corp, I think one of the main things to consider there is avoiding these hobby issues, because a lot of people keep asking questions about being audited and things like that. And I know Sean's going to talk about that, but by showing the IRS and the taxable body that you're serious about this and that you're taking it seriously, and going through the process of going and creating an LLC S corp and doing the tax schedules, because the other thing about an LLC S corp is that you have to pay taxes quarterly, so every 3 months. So there it is a little bit more on you, right? Because you have to calculate all of your taxes every 3 months. And that also, again, leads to the fact that this is not a hobby. I'm taking it very seriously. The other
No,
thing that I wanted to
spot on.
mention, yeah, and the other thing I wanted to mention is I personally have known people that have been using Coinly. So I have I think it's a $10 off or $20 off coupon code. And the way that that works, and I'll post it for everybody if you guys want to use that. And I'll post it, and if you use it, I think it gives me a kickback. And if it does, we're gonna put that into like a slush fund so that we can push out some of our merchandise in the future. We can use it for shipping and stuff like that. So if you guys use that and some of the money comes back to the project, we'll use it to ship out merchandise once we have that stuff up and running. So I'll post that in one of these tax sections for you guys to use going forward. All right, so it's to the questions. We'll start off at the top. One of the first questions that we got was from How, and How asked, "How would your initial investment into strong nodes be classified? Would it be classified as a fee?"
So great question there. So that's been the question of the last 6 months that we've been determined to try to come up with a reasonable answer on. Because the big thing about some of these investments that you guys are getting into is everyone's got a different smart contract, different terms of service, and what you can and cannot do. Um, so let's start with strong. So when you buy a strong node, you got to put in 10 strong. And today I was looking at it today, it was like $670. So that's $6,700 that you got to put in. So that's a lot of money to put down. And when you, the terms of service say you can't sell it, you can't lease it, you can't sublease it, you can't do anything with it other than continue to pay, excuse me, your monthly fee and collect your rewards. There's an argument there that this isn't really just an investment. From our perspective, and it's ever changing too. So the IRS could come in and make a hard determination that would be completely contradictory to this, and it wouldn't necessarily have to change our position. We would just have to put on our tax return that we're going to deduct these node costs, and then put a disclosure statement on the tax return, and then kind of duke it out with the IRS, and that could set some precedents with um, for people moving forward. Because technically, the IRS isn't 100% always correct. They're always trying to limit deductions. So there is a little wiggle room in there that we may be able to outbattle them. But just from this perspective, from what we're seeing and from colleagues that we've actually talked to in the industry that are also looking at this a lot, is the fact that this initial downstroke without any kind of ability to recapture investment by selling the node and it being tokenized, we're we're looking at it as a potential opportunity to deduct as either some sort of expense, maybe a licensing fee, franchising fees, probably not right, but it's something similar to that. And that's how we're leaning towards right now for our clients. And we have been for months now. And we're just trying to continue to find guidance that would help us with that determination. So that's what our initial thought is on that, which is pretty good news from your guys' perspective, because if you started with strong, you got a lot of strong. Those are big payments into the node. So we would write those off, and then it would be offset with any rewards that we later claim, but we'd have that write off right at the beginning, and then you'd get into a situation later where if you get to the point where you have 10 strong and you claim, say it was today, you claimed $6,700 of rewards, but then you put it right back into strong, you'd have $6,700 of revenue because you've collected that reward today, but then you'd have a corresponding $6,700 write off because you just built another node or you bought another node. Um, so from what we're seeing right now, we are comfortable with that position for our clients, but it's ever changing, and you're part of what you got to look out for too. And I'm going to kind of sidebar. Sorry for kind of going off track here a little bit, but from your perspective, everyone's got to have their own risk tolerance on this. Whether or not you're working with your personal CPA and you're that either knows or doesn't know crypto taxation, either way, they've got skin in the game as well. So you guys are signing your tax return. So if anything's fraudulent or materially misstated, the IRS could charge penalties and interest, and they could actually do that for your CPAs as well. So just throwing that out there. So um, everyone's doing their own research. I hope your CPAs are doing research if you are still working with prior CPAs, and that works well as long as you guys are getting the guidance you can or that you deserve on that. But from our perspective, we're pretty comfortable with the fact that we're going to be able to write off these nodes. But everyone's got to have their own risk tolerance on this thing.
Yeah, absolutely. That's a pretty good question, or and a pretty good answer. Um, Another question from How that was a follow-up question, I think, to the first one was, if my initial investment into strong nodes is $9,000, so three nodes for $3,000 a piece, then is the fee, right? So like we talked about it, I guess you would classify it as like a franchise fee, right? Is that classified as a business loss until you get your money back? And if you don't get your money back within that current year, can that loss be carried over to the next year?
So great question. So yeah, so in this scenario, I think in Howe's question, he mentioned $9,000. We'll just keep it say, yeah, $9,000 investment. So yes, you could write that off because what our position here is, you want to be a trader business, um, because we don't want to run into any hobby losses. So right now, whether or not you have an LLC set up or not, this will get reported on your personal return as income from a sole proprietor, and in that case, um, you're going to be subject to self-employment taxes, so you'll be able to write off business losses. So the good news about business losses, as long as they're allowable by the IRS and they don't challenge it as a hobby, is that those losses are actually able to offset other ordinary income. So say the only thing you did was on the second to last day of the year, or we'll just call it the last day of the year. You bought three nodes and they happen to be $3,000 a piece at that time. So you had $9,000 that you put in. That's actually $9,000 of a write off into a business, that you're able to actually offset other income with. So you'll be able to offset your wages or any other pass through income that you might have from other businesses and whatnot. So as long as it's a legitimate business, if you're in this where you're truly going to just treat it as a hobby and you just want to do a little investing on the side, then your losses actually aren't deductible. So that's why we're trying to make that trader business argument here. So as far as that goes, if you don't utilize, say you don't have any other income to offset, then yes, your loss would carry forward to future years. But if you've got income this year, say you got $9,000 you put into the strong nodes and you got a $50,000 W-2, that $9,000 is going to reduce your taxable income from your wage. Hope that makes sense.
Yeah, absolutely. I think it makes a lot of sense. Um, Real quick thing that I wanted to ask you, yes or no question. Does owning just an LLC give you any tax benefits? Just an LLC?
Just an LLC?
Yes.
No.
Good. Okay. So a lot of people will say, well, I have an LLC and I'm doing this. Well, is it an S Corp? No. Well, then what are you benefiting from it? I mean, you're protecting your assets potentially, but are you getting any tax benefits from it? You heard it right here. No, you're not getting any tax benefits from it. So if you're looking for tax benefits from an LLC, consider speaking with a CPA or speaking with Sean and getting an S Corp election set up with that. So I just wanted to point that out because sometimes that gets lost in the weeds.
Yeah, no, I want to follow up on that. With that, there's two different things. So if you have an LLC set up, it's not too late to make an S election to the back to the date that your LLC started. The IRS used to be pretty strict on that timing. So technically, it's supposed to be within 2.5 months of when you started your LLC. But they realize that a lot of people are starting LLCs and maybe not consulting their CPAs right away, and maybe didn't make the S election purely from the fact that they didn't file the appropriate form. So the IRS has some guidance out there to actually streamline the process to do late S elections. So it's not too late to do that to save on the self-employment taxes, and put a little distance between you and your cryptocurrency purely from the hobby loss side of things. So we think the S. So part of what an LLC does is, as Draco mentioned, is that it provides you some limited liability, but everything is still reported on your personal return as if you were a sole proprietor. So the IRS is still seeing everything meshed on your tax return. There's no separate bank account potentially. There's no separate tax return. So less of the formalities that come with a corporation that the IRS may be looking for someone who is truly treating this as a trader business and not just a hobby. So two different things that we think that the S election is: one, self-employment tax savings, and also helping our argument against hobby loss rules being applied to our deductions.
Awesome, awesome. Thank you for clarifying all that. All right, so moving on to the next question, Gigantor. How are DeFi and DAO projects being taxed like heck in Ohm? You kind of hit on that earlier, so I guess you can briefly hit that again.
Sure. So as I kind of mentioned before, so here's the different part, which I don't know, I don't think I mentioned before. So here's where you got to get, um, I don't know, not tricky part, but it is a little bit tricky where you're thinking, hey, I'm putting money into these node projects where I can't sell it, I can't do this or that, I can't lease. So we may be able to, and we're leaning towards being able to deduct that cost. With these DAOs, at least these particular projects, every project's different. There's opportunities to, you're putting into this project and you're staking it, but there's always an opportunity to unstake and take your money back out. Whether or not the value of that token or coin fluctuates up or down, you're always have a risk that, hey, you stake it, and then a month later you're still staking it and the price is halved. But you could still go back and unstake and sell your token. So that truly is more of an asset. So when you're looking at these projects, the money you're putting in technically aren't creating deductible expenses. So if you take money from a strong reward and then you transfer it into Ethereum and then eventually into Phantom and whatnot, going through all the exchanges, getting it to heck, you don't create any deductible expenses there. I mean, it's an investment. The best way I look at it is it's similar to either a savings account or even somewhat like a stock. And the reason why, I'll tell you that in a little bit. So, like a savings account, you got your money in there and you're receiving interest. As that interest hits your account, you are recognizing ordinary income. So, interest is actually taxed at ordinary income tax rates. And so are the rewards that you're receiving from these particular projects. So, and part of the reason why I, say that it's somewhat like a stock is that I'm not sure how many people here have stock portfolios or whatnot, but you can receive dividends and then have those automatically reinvested into your stock portfolio. And when that happens, you receive your dividend. The IRS is going to tax that or tax you on that, even if you immediately go buy an additional partial share or share in that stock. And it works the same way with these DAO projects. As the rewards or rebases are hitting your account, um, that's going to be taxable income to you. So you got to be aware of that. The value of the account will continue to grow, so there'll be unrealized gains in there. So you won't trigger any of those unrealized gains or losses in some scenarios until you either exchange the coin for another token or just outright sell it for USD. But from this perspective, you're going to have to recognize ordinary income, whether it be in the form of some sort of portfolio income, like an interest, or even just as revenue in your business, um, with every rebase you get. So even though you're not taking the money out, that is actually taxable income to you. Did that cover the question, or do you
Yeah,
think
I
I
think it
should?
does.
Okay,
No, no, no. I think that covers it very well. It's complicated. That would have been an easy way to say it. So
sure. And
it
and
is.
every
It is.
project,
It's complicated.
it's complicated, and every project's different too. So you can only talk about it from like a high level, but So every project's got its own terms of service, smart contracts, and how it all works. I know the DAOs typically work pretty similar, and so do the node projects and all that, but everything's got a little bit different going on. So whether you're working with another CPA or if you guys start to work with us, we talk about, hey, what projects are you in, and we'd have to look at those particular smart contracts. A lot of them we're familiar with as we've worked with folks like Dreko on this. Um, so we're familiar, but everything's got its own caveats that we'd have to look into. So a lot of it, I mean, what we're talking about today is high level stuff. But yeah, generally DAOs work in that fashion.
So this is a similar question from Rosie B, and I have to tell people when I see her name, in my head, I say Rosie B, and that's just how I see it. So I just have to say it from now on, Rosie B. So Rosie B wrote reflection investments that pay a small amount to holders every transaction. How do we find or report these? They often cannot be seen using traditional scanner sites. You kind of hit on that when we were talking about tracking our wallets and looking for
Mhm.
transactions. In Australia, they are probably reportable because airdrops are generally taxable as income at the value of the token on that day or time of the drop. Any suggestions on how we solve this headache?
So yeah, this is the ultimate problem or the ultimate concern here is the bookkeeping side of things. So if you're in a particular project that a Coinly or something along those lines hasn't coded their software to be able to track, then we're on our own, which is a scary thought. Because as you mentioned, some of this stuff is hitting um, rebases or even rewards from nodes or any type of transaction, or they're hitting by the minutes, by every 2 hours. How are you supposed to track what your ordinary income should be at the time of the receipt, and then what um, what the what your basis in that coin is now. So your basis in the particular token you're going to have to track as well. So how are you going to do that? So really, what it's going to come down to is coming up with a reasonable method for producing that report. So um, there's a couple different ways to do it, and every project's got its own the way they do things. But what I would do, and that's what I've preached to our existing clients and people thinking about signing up, is that there's no one answer right now. Really, you got to look at your risk tolerance on this thing, and then also something reasonable that you could go to the IRS and say, "Here's how I did it." Maybe it's not 100% right because it's impossible to go through every transaction and know exactly what the price was when it hit my wallet, and then track the basis for that particular coin. So a couple different suggestions. I'm not saying that's foolproof by any means. Is in that type of situation, what we may do, and there is risk associated with it because obviously you're not reporting it at the exact minute or exact second that this stuff hits your wallet, but it's to look at it. Hey, how often am I getting rebases, or how often am I getting payments? Um, if it's by the minute, maybe you do it by a day or a week where you look at, hey, I know I'm getting X amount per pay period, whatever that is, 8 hours, or you can have some kind of reasonable estimate of what you're receiving. And then you know what you're receiving per day or per week, and look at an average price for the week as long as there wasn't some huge drop at the back end of it or something like that. If the price stayed somewhat consistent, you can start having little buckets that you're gonna have to put together. And I'm not saying this is gonna be easy. If you have to do it by hand, it's gonna take time where you're gonna have to go through your wallet and make some reasonable assumptions. Here's what I was receiving as a yield on my investment, and you're gonna have to go from there. So it's not gonna be extremely scientific, and that's kind of what we've been going to if we have to go down that route. We're hoping that a lot of these softwares, as some of these projects become more prominent, start to incorporate that into their software. But if that isn't the case, you're going to have to do something by hand by in that nature. And I don't think there's any way to do it exactly right where you do every transaction. It's just nearly impossible. That stuff's hitting your wallets, at any time during the day. So I would recommend doing something along those lines where you come up with a reasonable method where you're saying, all right, I'm comfortable with the fact that this is close. And I would recommend erring on the high side of it. When I say that, I mean if you got to go do this by hand, I would recommend putting a little cushion in there. That means paying a little bit more tax, unfortunately. But if the IRS is going to audit you and then they go through it and they find less income, then they'll give you money back. You don't want to be on the other end of that where later you owe the IRS money. Not only is it tax, but late payment penalties, interest, and if they deem that you were materially misstated, they could charge additional penalties. So you got to be careful. Unfortunately, there's not a great way if you got to do this by hand, but it's reasonableness and substantiation, where you can show the IRS, I didn't just make this up. This was the best we could do. Here's my reasonable method for doing this, and here's my work papers for showing how I calculated it. So that's what the two big things are: the reasonable and substantiation for the IRS.
Great answer. Um, Next question is by Myron Gaines. How are NFTs treated? I guess it would be different depending on if you get income from them. So, how are NFTs treated as a purchase and taxed? And then the second question to that would be, what if that NFT earns you income?
Sure. So let's just start. Hey, you buy an NFT, and you're not necessarily earning passive income from it. It's just increasing, decreasing in value. So NFTs are, well, as a lot of you guys know, is somewhat comparable to digital art in the fact that these things are being created, and there's value to them, and they're going to be taxed similar to art that or tangible art that you could actually hold. And the fact that it's a collectible, and collectibles have their own tax rate. So if you buy your NFT and you sell it within a year, it's going to be short term income. And you're going to be taxed at ordinary income tax rates, as you would with a lot of other items that you do in the crypto world, or even not crypto. Anything that you've conducted in less than a year is generally going to be short term, and you're going to get hit with ordinary income tax rate. If you hold on to it for longer than a year, and then you sell it, it's going to be deemed a collectible, and you're going to be taxed at not the long-term capital gains rates, which are um, could and here in the U.S. could range anywhere from zero, depending on your income, all the way up to 20%. Their collectibles have a separate tax rate, which is 28% at the federal level. So from that perspective, it just will be treated just like any tangible art, and the fact that it's a collectible, and you're looking to hold on to it for a year and get that beneficial tax rate, as compared to the highest ordinary income tax rates, which are 37% as it stands right now. So, and then the other side of it, hey, if it's earning you income, it's going to be similar to um, the DAOs, and the fact that depending on what rewards you're getting, that reward you get is going to be treated as ordinary income to you, and it hits your wallet. The NFT in itself is actually going to stay the same in the fact that it's an asset that'll be on the books of for you personally, or if you start an LLC, it'll be on your balance sheet as an asset that'll stay there, and then depending on how long you hold it, there will be either short-term capital gains or a collectible 28% tax rate on it when you sell. But the earnings from it will be ordinary income to you as they get airdropped or whatnot into your account.
Awesome. That was a pretty good answer. Again, none of these are like easy answers, right? So they all have unique situations, and in each NFT is unique. So yeah, that's tough. But you know what? That's a good way to look at it. It's kind of like um, approaching these projects that have different incomes at different levels, and they're doing airdrops and stuff like that. You just have to do the best with what you got. Um, Next question by Smoky Mountain Wrestling is, he has a friend that is asking, what are some common red flags that may or may not trigger an audit for crypto investors specifically?
Sure. So, I mean, red flags, from my perspective, would just be just not reporting at all. Obviously, from that perspective, the IRS is going to catch on at some point. They're going to see money hitting your regular bank accounts if they're savvy enough, and as they start to um, what happens actually, it was few years back, and the IRS is putting even more pressure on the exchanges like Coinbase and Kraken and whatnot, where those companies did, or they have recently, if they haven't been doing it forever, I don't think they have, but they're doing a know your customer now. And by that they means they're taking your social security number or whatever your identification number is, depending on where you live, and your driver's license, and everything about you. So now they know who you are, and the IRS is going to know who put money in through Coinbase, because Coinbase is going to have to do some sort of reporting to them. Whether or not it's efficient right now is up for discussion, but it's coming. I know they've already pressured Coinbase and whatnot to get them information on that. So I think they've already been providing that to them. I just don't think the IRS has the staff to deal with it right now. But it's coming. So not reporting is bad. Um, as far as red flags specific to crypto investors, um, I think a lot of it just goes back the same way that a regular investor. I mean, if you got a lot of losses, so part of the reason why we recommend these separate LLCs with the S corp election is that if you're doing a lot of investing in year one and you have losses, the IRS doesn't like to see losses on personal returns. That's where it really triggers hobby losses. So they're gonna look into it. So unfortunately, for 2021, there's not a whole ton you can do right now if you didn't already have an LLC set up, but you'd want to get one set up as soon as you can in 2022. Pull that stuff off of your personal return, and get into a S corporation where be able to show your trader business. And obviously, the goal is to be profitable and whatnot, but you want to avoid any kind of situation where they're able to look back at your prior return and say, "Hey, man, you took a bunch of losses on this. You're really not doing this for profit. Maybe you made some money this year, but we're going to deny all your expenses." Um, so those are two big things. And then I guess from that standpoint, it's just reasonable um, positions on your tax return. So one thing you may have to do, depending on your CPA and their comfort level and all that, and there's still a lot of discussion on whether or not all crypto people should do this, is the disclosure statements that you do when you take a position that the IRS doesn't necessarily agree with, or you don't agree with the IRS on, or one that's hasn't been fully vetted by either the IRS or the tax and accounting community. So, you may put on the tax return, hey, I'm taking this position that these nodes are deductible and whatnot. I don't think it triggers an audit, but it automatically triggers a review from a um, revenue agent. So it's not technically a full blown audit, but someone's going to discuss that with you. So there's a few different things. I mean, at the end of the day, if you make a reasonable effort to report your income, um, then you have no issues. But if you go out of your way to kind of skirt the system, then the IRS is, in my opinion, they're going to catch up one day. Maybe not anytime soon, 5, said 10 years maybe, but um, I'd imagine it'd be quicker than that. But we all know the IRS, so they could be behind forever. But they're going to get agents out here that are going to be savvy enough to know how these things work. So they're going to know the money that went out of Coinbase into your wallet, and then either subpoenas or whatnot, get access to for your information. Hey, what did you do with this? And then all of a sudden now you got all this money flowing all over the place, and it just kind of worms out from there to the point where now it's too late and the IRS knows and you're unbelievably behind in tax, but then penalties and interest. So I would just recommend, trying to take some reasonable positions. I mean, crypto is great; it's making people money, but the IRS is the IRS, and they're going to look for their share.
Yeah, that's really good advice. Yeah, they're not gonna they're not gonna let it go, and obviously the government's taking a pretty good stand on it when they're hiring, so many uh, accountants, and they're hiring so many investigators to try to help them find those funds. So they're taking it seriously as well. So make sure that you're taking it as seriously as they are. The next question is can I expense NFTs as a business expense if they are needed to earn in game? Um, I guess we'll just take that question first.
Sure. So in general, every project's going to have its own uh, terms of service and what you can do with your NFTs and whatnot. But I understand kind of I mean, originally, I mean, for Strong, you could buy an NFT, um, but then you're allowed to sell it and whatnot. But um, and there's the same with some projects like that. So in that type of scenario where you buy it and it truly just gives you access, the NFT is going to be treated this is similar way to just buying a regular NFT. So no, it's not going to be business deductible as an expense. Rather, it's just going to be an asset on your tax return, and then you're subject to the same collectibles rules. There may be project out there that I'm unaware of there that, you buy the NFT, you're limited in what you can do with it, you can't sell it. Then I'd be, interested to see that terms of service and see if we can make some argument to deduct that. But in any scenario in which you're able to freely do whatever you want with that NFT, in my opinion, it would not be deductible and it would be treated as an asset of the business and then subject to the same rules as if you just bought the NFT um, outright and you're just holding it for personal use.
So the next question from How is what is a good tax tool to gather your transactions? We kind of talked about that and gave some examples such as Coinly, CoinTracker, and these other companies. But to be honest with you, you might have to go through them and check for yourself based on the projects that you're using. And a lot of people have found that when you're dealing with other blockchains such as Phantom, AVAX, BSC, Solana, and all that stuff, you actually have to go into the trackers. So like whether it's Ethereum scan or Ether scan or anything like that, you actually have to go in there and download the file, the CXV file, and then upload it physically yourself to those tax programs because they can't see those blockchains. So you might have to do it that way, where you go into each wallet, download the actual file, and then upload it to those websites that we're talking about. That's what I have heard, and that's what I've experienced. It is the best way to conduct that. So, yeah, you're just gonna have to find one that works for you. And to be honest with you, most of them have a return policy, so read that first. Try it out, and if they have a return policy and it doesn't work for you, maybe try another, another company. So that would be my advice. Do you have anything to add to that?
No, that's spot on. So a lot of what we've been seeing is these softwares are good to like kind of get your foot in the door and get started, but they do require some work on your guys' end to clean up, and you got to look at it. Hey, is this reasonable? Is this what I think I made? And if it's nowhere near it, it's probably something similar to that. Where there's a lot of coding you got to do on your end as well, as far as labeling what the transactions are. Yeah, there's a lot of work to be done with that, and I would agree. I would kind of echo everything that you said there.
All right, so the next question is from Pinhead Yoshi. Pinhead Yoshi is asking if CoinTracker is a reliable source. The answer is yes, if used properly. You have to make sure everything's put in there properly. It will not read everything properly, it will miss things. So you have to go and double check yourself. When it comes to all of your assets, how can you report these on your taxes? And if you don't realize the profits in your wallet, like in your actual bank account, are they still something that you have to report? And if so, how do you go about doing that?
So there's going to be two different things, and so I'll just touch base very quickly on the coin tracker side of things. Much like Dreko was saying, yeah, if used properly, and I mentioned it before, and it's just something that's just in the general accounting community where it was QuickBook files before for non-crypto businesses, and now it's these softwares where if the information going in is garbage, the product coming out on the back end is going to be garbage in, garbage out. So the trackers are going to do what they can to pull stuff in, but there's going to be some cleanup that you guys need to do to make sure that what it's kicking out is correct. So if it's got wrong assumptions, then it's never going to be right. But as far as how to report all this, so whether or not, so if you have an LLC um, that you make an S election, we report that on a small business or small corporate tax return. So it's an 1120S. So we'd recognize revenue from any rebase rewards or no rewards that you've received as the top line revenue, and then expenses along the line for whatever we deem that we can deduct. So whether it be strong nodes that we've purchased or other nodes in that matter that operate the same way as strong. There would be other expenses. I mean, it's not just purely the crypto stuff. I know it was recommended to me, so I'm sure it was recommended to everyone. Hey, buy a separate laptop, whether it be a Chromebook or whatever it be, strictly for crypto. You would want to write that off because that's part of your business expense. You wouldn't have done it outside, if you weren't doing the crypto. If you buy a safe, any kind of security and whatnot, anything along those lines that has strictly to do with the crypto business that you're running, then you'd want to make sure that you're writing that off. And then as you work with a CPA on that, I would recommend bringing more to the table than little. So don't assume that something's non-deductible. Let your CPA tell you that because they're not going to know what your expenses are if you don't tell them. So I would recommend try it. Well, I'll say push the button, but like bring it up to your CPA saying, hey, here's what I've got. Can you let me know what's deductible or what portion of this may be deductible? Because a lot of people are working out of office from their home, so they'll be part of a home office that you might be able to write off things like that. So as far as how to report it, it depends on how it is. You either report it as a sole proprietor on Schedule C if you don't have the LLC with the S election. Otherwise, we'll report it on the S corp tax, which will flow through to your personal return anyway. And then we touch base on this a little bit. So if you don't realize any profits and you just left them in the respective coins, um, I guess it depends on the particular project itself. I mean, if you just bought Ethereum and let it sit forever, long as there's no hard forks where you get any kind of airdrops or anything like that, then no, you got no issues, no taxable events. But I'm assuming the rest of your questions are talking about Ohm, Strong, and things like that. Those rewards are going to be taxable, as we talked about before, even if you don't pull anything out to U.S. dollars or whatever the native currency that you may be working with. So yeah, so I those are going to be taxable depending on what your other business expenses are. The revenue will be taxable. You may have expenses to offset it depending on the particular project you're investing in and what you're doing there.
Awesome, awesome, awesome. All right, so I'm gonna ask like two or three more written questions if you're good with that, and then I want to make sure that people have an opportunity to ask a few questions live if they really want to participate in that, and if they don't, then maybe we can fit one or two more in. But I'll leave it up to you. I figure we'll do two or three more of these, and then we'll see what people want if they want to come up and ask a live question.
Yeah, that sounds great.
Okay, so one question I saw that stuck out was, what if my wallet got hacked? At all. I mean, I think that if we made this a general question, if your wallet gets hacked and you had funds in there, can you claim that as a loss? Is that a taxable thing that you can work with your CPA with?
Yeah, so typically, with person, so it depends on how you're set up. So if you're set up as a business, I mean, that's a business asset that is lost. So yes, you'll be able to write that off. If it's a personal asset, um, then you got to deal with the casualty theft and loss rules where there are abilities to write that off. So even if like your car or anything in your home was lost, it would work the same way as that. So yes, there are opportunities to write that off. I would recommend working with a CPA on that to get the specifics of your situation, and then seeing where the best place to report that is, depending on what you got going on. So I would, assuming it was hacked and everything's gone, um, I'd recommend writing that off. And the same would go for kind of spinning off the project or question, but maybe there's something later. Or I know it's happened to certain folks, but if you happen to invest in a project that unfortunately doesn't go as well as you think, or you're dealing with um, sketchy individuals who rug the project or whatnot, then it would work the same way that way as well.
And then another good question that stuck out, and I'm going to add to it really quick. So it'll be the question they asked, and then I'll put a little caveat on there. The question they asked was, does it matter? Does your tax situation matter based on what state you live in? So does the state you live in impact your taxes for crypto? And then on top of that, does it matter what state they live in if they wanted to call you and work with you, even though you're working in Schaumburg? Does it matter if they're in Nevada or Washington State?
Sure. So, does the state in which you live have a major impact on taxes for crypto? Um, yes and no, just because each state's got different tax rules. Um, I know some states aren't as favorable for crypto as we're starting to learn more and more about it. The states are starting to learn it, and some of them don't like it. So we just want to make sure we position it. If you set up an LLC, there's some states that you wouldn't want to start in, um, but we could talk about that as well. But from a tax perspective, um, really the big thing is a lot of these corporation or a lot of these states get their the income that they're going to tax you on based on the federal tax return. So they're relying on the IRS to create some guidelines, and then they just tax you based on the income that flows through to them. So the different states are going to have different tax rates. Some are better than others. Some states don't have uh, state income tax, so those ones are great. So uh, Texas, Nevada, Florida, things like that. And then as far as can we help you guys out? Absolutely. We are um, we operate out of the suburbs of Chicago, but we've got clients all over the country. And as I mentioned, we come from various backgrounds with a lot of resources. So we pal around with a larger firm as well, who have about 250 accountants, where they may not be doing much with crypto specifically, but they have state and local tax experts that we could tap into if we ever got into that issue. But right now, really, we're working with all 50 states here, and we're comfortable doing that, and we've been doing it for years. So we could absolutely help any one of you. And then even from setting up an LLC, we may not be licensed in your state, but we are definitely able to. We have part of a program through our law side where we have contacts in every state who can do the final review and sign off of any documents that we're preparing. So we could help with any state.
Okay, awesome. And then I think what we'll do here, if you're good with it, we're gonna open it up and see if anybody wants to ask a question live. If you guys are typing a question or you didn't get your question answered, put your hand up and we can call you up here and you can ask it live, and we can try to get a couple of these across before we hit the 9:30 mark. So if anybody wants to come up and ask a question, let me know, and if not, we'll just try to rattle off a couple more that have been typed. But now's a good opportunity to come up and introduce yourself and ask if you wanted to. Doesn't look like anybody wants to yet. Oh, well, we got one. Rugsy is going to be coming up to speak. I sent you the invite. What's going on, man?
How's it going? Can you hear me?
Doing good. Yeah, I can hear you.
Cool, I got it right. Thanks for showing up tonight. Appreciate all the info.
No problem. Thanks for having me.
Yeah, absolutely. I thought of something this morning, and we briefly talked about how if you're staking a DAO, you're getting taxed on each rebase.
Yes.
So if you wrap it, you're not taxed until you're correct?
I don't know if that was just me, but you cut out a little bit. I think your question was if you wrap it, you're not taxed on the earnings.
Until you unwrap it, and then it becomes a recognized gain, correct?
So there's conflicting thoughts out on there, where it's wrapped, and it depends on the particular project in itself. So if there's limitations on when you can unwrap it, I would agree with that. But if you're able to unwrap it at any point, the IRS potentially could make an argument that you have constructive receipt of anything in that wallet. All you got to do is unwrap it. So it would depend on each project, and actually that's one of our things that we're looking into as well, because we think that could be a good play as well. And we're going down to a crypto taxation conference down in Arizona in a couple weeks, and that's one of the big things that we're gonna ask all the separate CPAs who actually show up, and from that perspective, what they're thinking on that. Because the big thing is that constructive receipt rule that the IRS has. So it depends, unfortunately.
Yeah, it seems kind of tricky because your value is going up, but the token amount's not going up.
Right. So it's all about whether or not you're able to access that money, um, is what the IRS is going to argue. And we can, as we learn more about each particular project and what they allow you to do, or what, more importantly, what they don't allow you to do in those scenarios. If they restrict anything you can do, then we can start making arguments about, hey, I didn't actually have access to that money. I couldn't do anything with it. But if it's just as easy as unwrapping it, um, then the IRS may be successful in any kind of constructive receipt argument that they make, where they say, this is truly just taxable income, and you just have it all wrapped right now, but you could just as easily unwrap it and figure out what you've earned. So, unfortunately, I don't have a concrete answer on that. Um, it's something definitely to continue to look into, and we certainly are. Um, so it's a potential good option depending on the particular terms of service of each project and how what they allow you to do with that wrapping of the coins.
Okay. Yeah, that kind of changes the second part of my question. I was thinking that if it is a fact that you don't get taxed until you unwrap it, you could use it in your favor to unwrap it to claim a loss as well.
Right. So, yeah, depending on what your determination is between you, your CPA, and whatnot. If that is something you to determine to, then I would agree with that. Right now, it's something we're looking into, and we've had the same thought as well. We're just trying to get some either confirmation, or so that we're not just completely stepping out of bounds here, because you don't want to start materially misstating your income, or otherwise the IRS expands the time that the statute of limitations are for your tax return to audit you. So that's part of what we're trying to do, is create substantiation for the positions we're taking. So I would keep that one if I were you guys. Just look into uh, wrapping things, how that may be taxed and whatnot, and we're going to continue to do that. And I'm sure as we come up with more information, we'll try to keep everyone apprised on that.
I appreciate that. Yeah, everyone's kind of selling it as, hey, you're not taxed, so I'll
Yeah,
definitely keep that in mind.
yeah, and it very well could be the case. It's just this receipt rule is what worries us. So we're just trying to make sure that there's no loopholes for the IRS to kind of pull that back.
Perfect. I appreciate it.
Yeah, thank you. That was a great question, man. I appreciate it. All right, MM Josh, I think go ahead and unmute yourself. It should be like right down at the bottom of where your name. There it is. You got it.
Okay, yeah, there we go. All right. Yeah, thanks, Draco, for hosting this, and Sean, thanks also for speaking. I will start off by saying, Sean, that I actually just recently signed an agreement with your firm to assist me with setting up my LLC and S corp, and also tax consultation and preparation. So I'm looking
Perfect.
forward to yeah, moving forward with you guys. So my question is banks. So I've read and heard that when you're trying to find a bank to, I guess, link the business with, and if you mention the word crypto, they seem to kind of shudder and turn a blind eye to you, and it just makes it harder to find a bank. And I was just curious what your experience with that is.
Sure. You're spot on where the banks don't want to touch crypto. You mentioned your crypto business, they're going to turn you away. So, um, my experience with the clients that we've had, um, trying to set up bank accounts is, yeah, that same scenario where they're going to turn you away. So let's just say we've gotten creative with the way that we portray the business, and by no means am I saying go lie to your bank or anything like that. But truly, what crypto is, you can describe it. We've had people with success going to the bank, describing it as doing more data hosting or services along those lines. And not lying if they mention, hey, is it a crypto business? I wouldn't say no. I would say, yeah, that's what I'm doing. But if you go in with that particular wording, that you're really just doing data hosting and along those lines, then the banks tend to be okay with that, as long as, because the problem is, or at least our thought on what the problem is that they think you're really like a crypto exchange. They just don't get it, and really all you're doing is trading crypto. Granted, it is a little bit of a threat to the banks as they exist now, as more people adopt into utilizing cryptos for various things. But I think that's their big issue right now. At least that's what I've heard. So data hosting seems to be a good way of doing it. I know Dreko was one of the first that I talked to as he was going through banks. So maybe you got any thoughts on that?
Yeah, give me a few minutes and I'll get some of the verbiage that we've heard of or that we've experienced that worked. So pretty much what we found out was banks are very comfortable with what they know. If you go into a bank and say, "Hey, how do I slaughter a pig?" They're not going to know how to answer that question because that's not their wheelhouse. But if you go in there and you start talking about accounting and numbers and interest rates, they're really good at that. So if you can find a way to articulate this in their words and what they're comfortable with without misrepresenting the business, they are 100% on board. So I have seen some verbiage on that in the past, and I'm looking for it now. So give me a minute, and I'll find it. This is a recorded interview, so you can come back if you have to go somewhere. But I will find it for you, and I'll tell you what we've found and the verbiage that we've seen people use in the past that was successful.
All right, appreciate it. Thanks, guys.
Yeah, no
Okay.
problem.
Looking forward to working with you.
All right, so we're going to go ahead and bring up Greg 5, and I'm going to boot you down to the audience. Just go ahead and, oh no, I wanted him to yell. There you
Hello.
go. Yep, I can hear you.
Thank you. I have two questions about a specific NFT project that's unique compared to most NFTs I've seen. It's a 10,000 mints NFT project, but they've set it up as an experiment where NFTs can consume other NFTs. And when that happens, the surviving NFT evolves, presumably to a more valuable one, and the consumed one is burnt. So from a tax consideration perspective, the burnt one wasn't, I'm not sure it's treated as a disposition. I would not have received in normal terms, consideration for it. So not clear if it's more like a casualty loss of a loss of a NFT as a personal possession, or if it gets included into the basis of the surviving and hopefully more valuable NFT. Any thoughts on how it should be treated?
Sure. So, for one, I think I would need to talk to you a little bit more about in depth of what this is, but it sounds like to me, so you have multiple NFTs that compete against each other, and then you are guaranteed for one of them come out on the back end. Is that what you said, or are they competing against other people, and then you may just be out of luck?
In order for one to eat another, you have to own both. So
Okay.
you have to acquire the NFT, which would be an acquisition, and so you, in essence, destroy one of your own NFTs to make one of the others more valuable.
Yeah. So just from that perspective, since you're kind of controlling the game, um, I would imagine the IRS would take a position that you're just increasing the basis in the new, more valuable NFT from that perspective, just because there really is no law. So what part of what the IRS does, so to try and kind of equate it to other terms, is that there's got to be an arm's length transaction in order to recognize a loss. So not specific just to cryptos, in any kind of scenario where if you do business with yourself, like if you have another business or even a family member where you sell them something at a loss, you're not going to be allowed to take any losses. It's all going to be deferred until the final um, asset, or whatever in that scenario is sold to an outside party. So I got to imagine that's the position they take. I'd be happy to look into it more, and it's a very interesting concept. It's not something I'll admit I haven't heard of that. So I would be more than happy to talk about it further and to learn more about it. But from my perspective, from hearing very briefly what you just mentioned, I'd imagine that they would increase your basis, and so they just combine the basis into a new NFT, since it kind of combined into a new bigger NFT. It sounds like.
Yeah, sounds perfect. It really just changes the attributes of the second NFT rather than
Right.
literally being a new FT from I think from legal entity purpose. Thank you. That matches what I would hope it would be. And a related question is they launched it once rather stealth with less traction than they anticipated. And so they shut it down and they're relaunching it. But when they shut it down, they refunded the mint prices, but didn't stop any people from minting new ones. But I still have the NFT that now is unmarketable and useless, but I still technically own it. If this had been a cash-based transaction, I would believe the right accounting is in essence a refund, is an overpayment that they decided to apply a discount after the fact. But since this is crypto, I'm concerned that tax-wise it was treated as, no, I have a basis in a NFT that in essence is worthless, that I can't sell because it's not marketable. So I can never take off the loss, and the refund is treated as income. My preference is that no, it's a refund, and I retain the original basis and I retain the original acquisition date. But I'm not sure that the IRS would see it that way.
Yeah. So that's another interesting one. Um, we'd have to look into a little bit more there, but just initial thought, I would kind of agree where, so it's not, yeah, the main, so technically casualty losses or any kind of loss in that type of situation, the IRS, like on a worthless piece of like loan or anything like that, a worthless asset, they don't let you write anything off until it's completely worthless, in the stance that, it's either gone or absolutely has no chance of retrieving any value. So if you're still holding it with the intent of selling it, I mean, it potentially still would have that basis, and then the refund could, one of two things, could be either be taxable income, or it could even just reduce your basis and now this worthless asset. So it'd be interesting to see what the IRS may do with that. So we'd have to look a lot more closely at what the contract said, how everything kind of exactly played out to kind of make a reasonable determination there. So um, it's an interesting one. I don't have an exact answer for you, but um, it could potentially be that second scenario where that the fact that it's not completely worthless, you'd have to do something with your refund, and now you may just have no basis in this worthless NFT.
Okay, thanks for your thoughts. Appreciate it.
No problem.
Awesome. All right, so we'll go ahead and have I don't know how to pronounce your name, but in the meantime, while you're coming up, I just went ahead and sent you the invite. I'm going to go ahead and read this off to you. I found what we were talking about before. So for the previous question, this is what we've seen work in the past. So if you walk into a bank, let's say you're working with just cryptocurrency, and you said, you know, I'm investing in cryptocurrency and I'm treating it as a business, blah, 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 blah. They're not going to like that very much. But if you use the terminology of this is an LLC that is a financial holdings company in the technology sector, you're vague, you're providing vague information, but it's the same thing as saying that I'm investing in cryptocurrency as an LLC. If they ask additional questions, obviously tell the truth, you shouldn't lie. But that is using terminology that they understand. If you're doing something such as strong nodes and other type of node projects, that's a little bit even more difficult to explain. So if you go in there and say, you know, I'm purchasing nodes as a service in the world of crypto that provides a service to other blockchains, and I get rewards in cryptocurrency, their heads are going to explode. But if you said the LLC is a financial holdings company in the technology sector, and the company, through its subsidiaries and partners, provides information technology outsourcing software and hardware services. It's the same thing. Now, if they want to ask a bunch of questions to get deep dived into that type of information, they can do so. And you should answer that. But with that being said, don't, if you go in there and provide too much information, you might push them away from you because they don't understand what it is you're trying to do. So that's not financial advice, but what it is it's a way for you to give them the same amount of information that they understand. So I hopefully that makes sense. Does that make sense to you, Sean?
Yeah, no, that's spot on. So really, all it is, I mean, you don't want to lie to them, and you know, I mean, they're just confused. It's about how it all is working, and I don't think any part about what Dreko just said there is a lie. I mean, it's vague for sure, but I mean, it is what you guys are doing, and I would I haven't quite done it myself, but I intend to utilize that same strategy when I eventually go to set up a bank account for the LLC for all my crypto holdings.
Awesome. All right, so JEU, if you unmute yourself, you just click there you go. Can you pronounce their name so I don't butcher it?
It's Jew.
Okay.
Um, one quick thing, Dreko. Is it possible for what you said about the banking thing? Is it possible to have that in a message, pinned somewhere in the channel?
Sure.
I have two questions. First, thank you for putting this together and allowing us to have the opportunity to hear from somebody that, you know, that literally breathes taxes, because IRS is, woo. So my first question is in regards to, where would we be able to find your information for your firm if we're interested in your firm?
Sure. So
I
I would
posted it in
be
the tax
completely
question
okay.
section.
Got it. So I think, yeah, our website's been posted, so you could, if you're interested in setting up a call with us, how we typically do things is reaching out to our general information line or email, which should be posted on the website, and then we have our admin monitoring that, and they'll set up a call with one of our accountants and CPAs to have an initial call, discuss your particular situation, discuss more specifics about, you know, how we work, our processes, our pricing, and whatnot to make sure it's all a good fit both for you guys and for us. And we'd be more than delighted to help you guys with your tax and accounting and tax planning moving forward. But yeah, so that's the process, and then we'd reach back out with a call, and especially now we're getting in the uh, crunch time here, so we'd love to hear from anyone who would be interested. And you know, if you reach out and it's not for you, that's completely fine. We'd rather you guys get as much information as you can from us as far as how we work and what we do, and then we can go from there. You know, we found great success with a lot of the crypto folks that have come knocking on the door so far, and I think everyone's been pleased, and I'm sure you guys would as well.
You said the website is posted where, Dreko?
I just put it in the tax question section, and we'll post it again in general chat here, and then we'll pin it to announcements once we're done with all of this and I have time to type.
Okay, thank you so much. My 1 second, I gotta switch it from push to talk. My second question is more towards like the general a CPA. If we're looking for a local area CPA, it's a two-part question. What are some of the things we need to be looking for in a CPA that can handle this thing besides knowledge of crypto, but besides knowledge and for like willingness to engage crypto? What are some things we need to be looking in a CPA for looking for in a CPA? And then my second question, in your estimation, why do you think the bulk of like the CPA community is avoiding crypto, even though you see that the IRS, Congress, the Fed, they're talking about it and they know that they have to wrestle with it? Why are CPAs avoiding it still?
Because life is tough and math is hard.
Exactly. No, so really what it is too, and I mean it's actually not that far off. Where a lot of this there's risk for the CPA as well. So when we prepare tax returns, there's preparer penalties if we materially misstate anything, and then there's actually risk to lose your license if the IRS determines anything you do is fraudulent and whatnot. And so a lot of the CPAs and actually just the accounting CPA world just in general, not trying to knock any older folks or whatnot, but the community is older than it is on the older side of things. So not a lot of older CPAs who run larger CPA practices are comfortable with crypto whatsoever, and they're not willing to make that investment into into learning about it or even training their people. So they're comfortable with the way they've got things, and they don't want to risk it. So that's the only reason I could think of, just because, as you mentioned, everyone's talking about it, it's all over the news. The IRS is legitimizing it in the fact that they're going to learn how to tax it, so it's going to be part of the law. I just think there's folks that it's not just crypto. There's a lot of different parts of the tax world that CPAs, when they get comfortable, they'll only work with a certain type of clients that they like. So some of them only work with real estate. Some of them will only work with doctors, and things like that. They get comfortable in a certain field, so they stick to their niche and they're done. Why the big companies aren't looking at it, I have no idea. I'm sure they're starting to get experts and whatnot, and maybe they just weren't comfortable enough to communicate with us on what their thoughts are. But yeah, that would be my initial thought there, is that they're comfortable and they don't want to risk it. As far as a CPA goes, yeah, I mean, obviously one close to home is always more comforting than across the country. Um, so yeah, from my perspective, if I was looking for another CPA, I would look for that eagerness to learn. So I'm not gonna lie to you guys. I mean, you come to me 6, 7, 8 months ago. I don't know much about crypto other than the random Ethereum and a little bit of, like, I don't know, random coins that I had bought. I understand a little bit about what a hard fork is, but not nearly to the point of what gas fees are. I don't even know what a node is at that point. So there's a lot to learn. And there's still a lot to learn for me and our firm in general. But from your perspective, if you've got a CPA that is willing to work with you, and they got to be just as invested in it as you are, where they want to learn about it. It can't be just to do your tax return and get it out the door. Otherwise, they'll never invest the time. It's really got to be they want to learn about crypto. They want to do this. So you got to see that energy, in my opinion, to want to learn about it. And if they're not willing to do that, I don't think you could possibly get the service that you need or deserve. Just because I know the amount of time that it's taken me to even get to the point where I'm at now, and I mean, it's been a lot of time, not even just in regular office hours, my weekends and whatnot, where I'm just trying to learn about crypto. It's an ever changing space. So if your tax accountant is literally just looking to get your tax return out the door and not learn how to evolve and um, grow with the crypto community, then from that perspective, I wouldn't work with that individual. But everyone's got their preferences on this.
Okay, thank you, thank you. And then my last question, and I'm done. I know you were talking about LLCs and S corps. I usually S corps are for individuals. Am I wrong on that? Because I'm in. It's me and a group of 5 that we basically we basically went into, well, I'm not going to say we went into crypto together, but we're like, we're going through the journey together. And the one thing we've been talking about lately is like, we don't want all 5 of us getting smacked with crazy tax bills. How would a small group, nothing crazy, let's say for my sake, 5 people, go about the tax question?
Sure. No, that's actually a great question. So, a S corporation is actually you're eligible to make that election as long as you have no more than 100 shareholders. So you, in theory, could do that with 5 shareholders. The problem that gets you into, you still save the self-employment tax, which is great. There's just more restrictions on an S corporation as opposed to an LLC with multiple members. So with an LLC with multiple members, you would be taxed as a partnership. You'd still have a separate tax return, but all the income flowing through to your personal return would all be subject to self-employment tax. Um, so you'd still be subject to that self-employment tax, but you do have the separate tax return, so it helps avoid the hobby loss rules. But you could make an S election, and the part of what is restrictive is the fact that everything's got to be in proportion to your ownership percentage. So when I say that, if everyone was equal in this thing, um, everyone's gonna be allocated 20% of the profits. If you were gonna get $1, the other 4 guys got to get $1. If you wanted to distribute yourself out $20, I mean, it goes, it could go to any number. You guys would have to distribute in proportion to your ownership percentage. When you're an individual, it's easy because it's literally just you. You take the money out how you please. You're 100%. You're doing everything in proportion to the ownership percentage because 100% of the income is on one person. But if you have multiple members, you just got to be a little bit more careful. And there's no issue with having an S corporation if you guys plan on doing that. If you have an LLC that you guys all plan on using money and running it all through the same company, but investing in different projects and taking out different money at different times, like different amount of money, then an S corporation doesn't make sense because you're restricted to doing things in proportion to your ownership percentage. But if you guys plan to do everything 20% each moving forward, everyone gets the same amount of distributions out of the company and things like that, then an S corporation can work just fine.
Okay, thank you so much. Hearing that, it sounds like LLC is the safer route to go, because that would suck if for example, oh snap, Dreko left. It would suck if, like, for example, we're into strong together, and then me myself, I start dabbling with Olympus Dow, and none of them are dabbling with Olympus Dow, and then I'm entitled to 20% profits because I'm only entitled to 20% profits because the money's going through the S corp. Okay, so LLC straight, plain and simple. Thank you so much, sir.
Not a problem. And so just from a high level, there'd be a lot of allocation of income you'd have to do there. So you're already talking about working with the CPA. So as long as your CPA is aware of who's invested in what project, then he should be able to help you allocate that stuff. So yeah, that's what I would recommend doing.
Okay, thank you so much.
No problem.
Thank you for the questions. All right, I think that brings us to a reasonable conclusion here. I want to bring up that you said that you are still taking on new clients, correct?
Absolutely. So yeah, we're happy to help the community. We're honored to be brought in here today. So thanks again for that, Dreko. And yeah, for all you guys, we're still taking on new clients. I mean, we're getting into tax season, so it's getting into crunch time. So we'd love to talk to you guys, and then we can figure out the best roadmap for each of you guys to get you rolling.
Yeah, I put your information for for the firm into the announcement section. If you guys don't find it or whatever, ask one of the founders or ask our mods. They'll get you the information. Um, and then when you get over there and you make a phone call, make sure you told them that Dreko sent you. It doesn't do anything for you, and it doesn't do anything for me. But I think it's funny that you're going to tell somebody that has no idea who I am that Dreko sent me. Just make sure you tell them, "Hey, Dreko sent me," and it won't do anything for you though.
But it's still good. We're all part of the same community, and no, we're excited. Crypto's going to be here for a long time, in our opinion, and we're glad to be part of it. So thanks for having us on, and always feel free to give us a ring if as you guys have our contact information, and we're happy to help however we can.
Absolutely, guys. So hopefully that was good for everybody. Hopefully you guys learned a lot. We plan on doing these in the future when it makes sense and when the community needs help on something. If something happens big, like if the Fed comes out and says something, or the the IRS makes a stance or something, then I assume we'll be seeing you back here soon.
Yes, I'd be happy to be back. So happy to help in any capacity that I can. So
Thank you
this
very
was
much.
great.
Thank you very much. I appreciate it. Have a good night, and everybody for coming out. Thank you for coming out. Cheers, and I'll talk to you guys next time. Have a good night.
All right, have a good one. Thanks for everyone for coming out.
Thank you.